Most people think they understand money because they use it every day. They earn it, spend it, save it, some might even invest or donate it. So naturally, they assume they know how it works. But here's the uncomfortable truth. Most people have a very poor understanding of money, especially the kind we use in today's monetary system. Unfortunately, that misunderstanding has real consequences. And once you understand what money actually is, you start to see the entire financial system very differently. So if you want to understand money better, make sure you stick around until the end, because you will definitely learn things that you don't already know about money but should know. So you might have heard someone like Robert Kiyosaki say that money is dead. And maybe that sounded confusing or exaggerated or just plain wrong. After all, money feels solid. It feels real, right? How can money be dead? How does that make any sense? And honestly, it's taken me years to understand that statement. But by the end of this video, you too will understand why that statement is true and why it's fundamental to how the entire fiat monetary system works. And once you see it, you cannot unsee it. So here's the core idea to keep in mind as we go forward. In the current monetary system, money is never an asset by itself. It's always someone else's liability. That someone else is usually a commercial bank, a central bank, or a government. So let's start with the kind of money that you use the most and the kind most people completely misunderstand. And that is commercial bank money. This is the balance you see in your bank account. Your salary gets paid into this account, your bills come out of it, your savings probably sit there too, or maybe in a separate account which claims to pay you a generous interest rate, but that's besides the point. The thing is, it feels like your money, but it's not sitting in a vault somewhere waiting for you, and it's not really yours in the way that you think or imagine. What you're looking at is actually a liability of the commercial bank you have an account with. So when you deposit money into a bank, you are not storing it, you are lending it to the bank. And in exchange, the bank gives you a promise, an IOU, that says, yes, we owe you this amount and you can withdraw it whenever you want as long as everything works as normal. And that last part is doing a lot of the work. So what you're really holding in your bank account is basically credit. Another way to think about your bank account balance is that it is a claim on the bank's balance sheet. You are trusting that when you ask for your money, the bank will be able and willing to honor that promise. Most of the time, that trust holds and everything works as normal until it doesn't. And when it doesn't, things get interesting very, very quickly.
My God! Okay, it's happening. Everybody stay calm.
What's the procedure, everyone? What's the procedure?
Stay calm!
Wait.
Everybody calm down!
Now let's zoom out one level, because banks don't operate in isolation. They actually sit inside a much larger system. And that brings us to the next form of money, which is central bank money. This includes physical cash, which are the notes in your wallet, and reserves, which are digital balances held by commercial banks at the central bank. The same way you have an account at the commercial bank, commercial banks have an account at the central bank. The only difference is what those balances represent. Your account holds commercial bank deposits and their account holds central bank reserves. But here's something most people don't realize. Cash is the only form of central bank money that is available to the public. Central bank reserves exist, but only inside the banking system. You and I cannot hold or access them and will never even see them. So when you're holding cash, just know that you're holding a liability of a central bank. In the US, that central bank is called the Federal Reserve. In Europe, it's called the European Central Bank. In the UK is the Bank of England, and so on. And yes, you can spend that cash. Yes, it feels and works like real money, but in reality, it's still someone else's promise. And that distinction matters more than most people think. Now, let's move on to the form of money that underpins the entire system, and most people never interact with it directly. That form of money is government money. This comes in the form of treasuries, bonds, and bills. You cannot buy fuel or food with them. You cannot spend them at the coffee shop. Basically, you cannot spend this form of money. But in the world of institutional finance, these government IOUs are treated as money, especially short-term ones like treasury bills. They are considered ultra-safe, highly liquid, and widely accepted as collateral, although that depends on the government issuing them. So when you hear that a corporation like Apple, for example, sits on tens of millions, if not hundreds of millions worth of cash, what that usually means is that they own a lot of government debt. Typically, that's in the form of short-term government debt like US T-bills. Those are used because they are liquid, they are easy to sell, and they carry minimal interest rate risk. But here's where things get interesting, and this might actually blow your mind entirely. The vast majority of people have no idea that US government debt is the collateral that underpins the entire global monetary system. Yes, I'm not joking. Banks, markets, derivatives, global trade, all of it ultimately depends on the US government keeping their promise to pay back their debts. And this is one of the main reasons why US government debt has exploded since 1971, the year President Nixon ended the gold standard. Once gold was removed, government debt didn't just increase, it became necessary in a structural way. And here's the part that nobody talks about in mainstream news. US government debt is mathematically guaranteed to keep growing. That's not because of bad politicians or because of poor fiscal discipline, and it's not because of which political party is in power. All that is completely irrelevant. This is in no way, shape or form a political problem. It is a structural feature, not a bug, of the monetary system itself, and it's already past the point of no return. So now we can put all the pieces together, and the big idea is this. In the fiat monetary system, money is never an asset. It's always someone else's promise to pay. Bank deposits are a commercial bank's liability, cash is a central bank's liability, and treasuries are a government's liability. Different forms, but the same structure. And what do all these forms of money have in common? If you know the answer, pause the video and comment it below. I'd be interested to see how many of you can get it right. But the answer is counterparty risk. Your money is only as good as the institution backing it. If the bank fails, if the government defaults, or if the system freezes, censors, or inflates your savings away, you are left holding a promise that cannot be kept. And that's the reality of fiat money. A reality that's been going on for over 50 years. So understand that fiat money is not backed by gold. It's not scarce. It's not final. It's just a huge web of IOUs. A system built on trust, confidence, and credit. It's basically promises stacked on top of promises all the way down. The good news is that for the first time in modern history, there is a viable alternative, especially in a digital economy like ours. We finally have a digital asset that is not someone else's liability. An asset that doesn't rely on a promise to pay, a balance sheet, or the continued trust in an institution. That alternative is called Bitcoin. And the reason why Bitcoin matters has very little to do with its price. Bitcoin is not issued by a bank, a central authority, or even a government. When you are holding Bitcoin, you are not holding a claim on anybody because there is no issuer standing behind it and no promise to redeem it for something else. You either hold it or you don't, just like with physical gold. That single distinction puts Bitcoin in a completely different category of money. Bitcoin exists as an asset that minimizes the need for trust. And in a system that expands by issuing more debt, Bitcoin follows fixed and transparent rules that don't change when things get difficult. You don't need to understand all the technical details yet. You just need to understand why Bitcoin is different. And once you see that difference, it becomes very hard to ignore. It's only a matter of time until more people wake up to it and adopt it. Question is, when will you wake up to it? Right, that's it for this video, guys. Thank you for watching until the end. Give this video a like if you enjoyed it, subscribe to the channel for more, comment your thoughts below, and until next time, keep stacking, keep hodling, and remember that a Bitcoin DCA keeps poverty away.